more than one of us are drinking on this stream, so this is going to be a fun one, I think. That's
Cheers.
okay. That doesn't count, Tanner. Like, I don't even know why you advertise that you're drinking that.
Yeah,
Um,
Tevis and I are drinking hard
Because I'm not
liquor. I don't know what the
ashamed.
hell you're drinking.
I'm not some dude that gets his testosterone boosted by saying I only drink hard alcohol. I think that having a vodka soda allows me to wake up in the morning with no hangover.
You need
here,
more
you guys
practice.
like my mug?
No, I don't need more practice. I think like I'm just a casual. I drink during special occasions, and this is a special occasion. Cheers, boys. We can talk about the more rumors about SoFi discontinuing crypto, the TGL launch delay. Anthony Noto might be buying the stock.
You're just reading my tweet now.
And then I am reading your tweet. And SoFi breaking into the 80th largest commercial bank in the United States. Here is a chart of SoFi's consolidated assets and the rankings against other large commercial banks. Along the way, SoFi has been ranked against their peers of only comparing to other banks that have over $300 million of consolidated assets. The first time that SoFi was a public bank was in Q1 of 2022. But now in the last 2 quarters, we went from 114 to the 90th place, now 80th place, leading us to $21.5 billion in consolidated assets. We continue to climb up. We want to be a top 10 bank actually by market cap. Do you think that we actually have to be the top 10 biggest banks to actually be a top 10 bank by market cap? Or do you think that we will get a premium because of the tech company?
We'll get a little bit of a premium as they continue to scale.
I don't really know which one would be easier. Like, what is the top 10 in terms of assets? Maybe you can pull up the full list, because to be a top 10 bank, it needs like $100 stock price.
Market cap's going to probably be easier than total assets.
That's what I was thinking too. The thing to consider is that the legacy institutions have declining assets. Like, that's a trend.
Number one, you got JP Morgan. All the way down to the 10th place, you have TD Bank.
Yeah, I mean,
366 billion. We are all the way down here. Lending Club used to be larger than us. 158. They used to be larger than us. Recently getting their bank license as well before SoFi, and we just absolutely surpassed them. It's crazy. As we start to get past, the number does get exponentially higher. You know, just to get to 62nd place is a 50% increase, pretty much. So
they did a 10x in 18 months in terms of the total assets, from 2 billion to 21, over a 5x from 449 down to 80.
A lot of that was just shifting from SoFi Technologies over to SoFi Bank, though.
Sure. You're not going to get a similar move over the next year. I definitely think they can break into the top 50 next year, or over the next 2 years at the very least. But that would mean what, like 35 billion assets under management?
Yeah, market cap's going to be a lot easier than the assets under custody. Just as they begin, and we talked about this, I think last week, as the tech platform continues to scale, more and more of that will be realized into the multiple. I think we're undervalued at this point. There's a realistic bear case, but that market cap can expand quite rapidly, especially if they get past the capital constraint bear case. So
you got to remember that for SoFi to really gain ground and break into the top 20 on an asset basis, they need to expand their business lines into business. I don't see them really getting there without a full business segment.
Them actually getting rid of crypto is putting them in sort of the good graces to regulators to potentially break into the SMB space. They have all the components there, you know, the payment technology, the multi-core banking technology through Technisys. They have the bank charter. They have all of it. They can issue their own cards, credit cards, everything like this. They have everything in place to go SMB. I think that it's impressive because all the companies that we're comparing to are not stagnant. Their opportunity is also to grow. Us growing not only in this environment, but also versus our competitors is extremely, extremely exciting. And the fact that we're already top 80 is really impressive on a consolidated assets basis.
Let me ask around that. How fair is it to make a linear extrapolation on an assets basis, just given where we are in the macro? Like, can we even do that? Or are there going to be more headwinds or more tailwinds for assets to accelerate or decelerate in the new year? Because right now it's been pretty much a 45-degree angle.
It's going to start slowing. We need to increase our lending capacity. We need to be able to actually grow our tangible book value. Yeah, I still think that we'll grow much faster than our competitors. People have been comparing us to this 6% unsecured personal loans net versus 5.5%. Like, why are we even getting into personal loans if it's only netting us 6%, whenever treasury bills can just get us 5.5? We have to remember that 6% is net of cost of funding, and it's net of default. Okay. One of the things that the 5.5% does not factor in is where's the cost of funding for that? Where do you get the money to invest in treasury bills? So if it's from SoFi's deposits, then you're going to be paying 4% on that. It's not actually 5.5 versus 6%. If you're paying 4% on your deposits, then it's actually 1.5% versus 6. If you're
Good point.
factoring in defaults already, then what's the difference between an unsecured personal loan and a treasury bill if you're already factoring in defaults? You already know they're more risky. You're pricing that into the net.
Well, it depends what the variance is from your projection, but that's going to be like super small.
Yes, it can get much worse. Treasury bills can get worse too, but it won't happen. It's just the cost of funding mainly though is not factored into that 5.5%. For someone who has their own capital, you don't have to worry about cost of funding.
Yeah, this isn't like Palantir where they're sitting on $3 billion in cash that you might as well. They don't have to raise that capital. It's there. No fee on that end, so they actually rake that in. Yeah, it makes sense what they're doing. And if they switch, then we're going with T-bills. I would be curious what they're seeing in the macro. As far as are they seeing like a spike in default rates coming among the lending segment that they have? Those credit ratings, like I would be shocked. Like if they pivoted that way, it would raise my eyebrows for sure.
I think people are misinterpreting the spreads and they're not thinking about the fact that companies like Palantir are not in the business of personal loans or lending money out and making a spread that way. SoFi has other ways to make money. In the future, when the Fed eventually does pivot, as the FedWatch tool that we keep looking at does indicate, most likely by June, the Fed will pivot and end the year somewhere with a four handle on rates. Treasury bills are not going to look as attractive going forward, and you'll be able to make a bigger spread on lending.
Someone in the chat just said, can you guys talk about deposits after Fed cuts? I assume people will take some cash and put it into investments, which will lower how many loans SoFi can sell. Is this bearish? Is this a nothing burger?
That's true, but if it's after the Fed cuts, we're going to be in a different market. Like we know after the Fed cuts, a lot of the things that are holding us back now with regards to loan sales are not going to be the case. And then we're going to be pivoting our revenue drivers, or at least from an originations perspective, away from personal loans and towards the other business segments. And then you have to keep in mind that a lot of people on the retail side, not SoFi's demographic, but a lot of people on the retail side don't even have a lot of disposable income that they're just actively keeping on the sidelines to take advantage of the market cycles.
I think we have to look at it a little bit from what Robinhood said. SoFi owns both sides of the market. So if the cash moves from, making net interest income into markets, okay, now we make transactional based revenue. I would even say the revenue would be higher in SoFi Invest than it would be in SoFi Money trading, payment for order flow.
It's also a volume game. Right now, there's a lot of people that are holding off on big purchases because of where rates are. Not everybody can afford to pay cash for a vehicle. Not everybody can pay cash to redo their kitchen or those types of things. When rates come down, you'll see an influx of people starting to make these bigger purchases that they may have held off on over the past year or two because of where rates are. And while the spread won't be as much, you may see more volume on loans and loan activity, which could net out to be the same profitability, if not more. We got to wait and see. But with rates where they are and personal loans where they are, people are not redoing kitchens or buying vehicles. You can see it in the auto sales. You can see it in consumer sentiment.
Think back to whenever SoFi wasn't even a bank before. We didn't even have deposits as an option. How did we loan out capital?
Well, we were borrowing. And
we borrow.
We were paying a bigger VIG.
Yeah. So even as rates fall, so do our rates on lending from warehouse facilities.
Yeah, but that's after we utilize the balance sheet.
Management has said that they want to lean heavier onto their own funds. Right? First, the point was saying 80 to 90% over the next several quarters. That obviously accounts for an environment where the Fed has maybe already started cutting.
I don't think that lending will slow because of a shift. I think that
it could pick up. It could increase.
Yeah, especially on the student loan side, it might shift from personal loan over to student loans. Maybe the buckets might change, but I don't actually think that the total amounts will change. I don't think SoFi is big enough to sort of see that impact. I think we have so many new members coming onto platform because of that switch. I think that's more of a problem for Bank of America or a JP Morgan long before that ever impacts a SoFi or something like this. I also don't think SoFi is going to lower their rates as interest rates come down. They have so much pricing power on a per dollar basis. Robinhood is asking for $5 a month and they'll give you 5%. SoFi does not ask you for $5 a month, but yet they're only offering you 4.6%. Is this because Robinhood is making so much more on this $5 a month that they're able to offer you 0.4% extra? No, they're just taking less of a margin than SoFi is. SoFi could absolutely go to that 5%. They are the bank. They are their own payment processor. They issue their own cards. They do all of these things that add so much extra margin expansion versus Robinhood that also Robinhood might even be a client of Technisys. SoFi is a client of Technisys, but they don't have to pay. Robinhood has to pay. I believe that Robinhood will have to start lowering their rates much quicker. And one of the companies that might be able to keep their rates higher for longer in an interest rate environment that is starting to come down will be SoFi amongst anyone else.
Yeah. And so that's actually going to lead to a net influx, I think. So I think that's exactly how it'll play out is SoFi, I think, will be able to be a little bit slower. And so they'll be able to acquire actually users maybe at a higher clip than that 500K that they project for, which is actually really bullish. A lot of that money is not going to instantly go into the markets. There will be some, there'll be some large purchases as well. The only scenario where I can really see that change is that fear of missing out kicking in. And I don't see that right now with crypto or in equities. So we're a ways away from that if that happens. I'll just add that this is a much more resilient company than it was pre-COVID. Pre-COVID, it was kind of a one-trick pony. And now there's multiple tricks. So as one is thriving, the others maybe are lagging behind. And as the macro changes, that changes as well. So it's a dynamic company with dynamic leadership. Under Noto, like it's able to adjust actually relatively quickly, very surprisingly, in a way that just defies the bears. So I don't have any concerns as those interest rates start to come down. It's going to look a little different the way that the company grows and the guidance. But yeah, different is not necessarily a bad thing.
I can't stress it enough, and I don't know why they don't really talk about it, but business is critical, especially when rates come down because the cost of capital is cheaper and you're going to probably see business expansion because businesses are more incentivized to take out business loans and expand, buy more equipment, hire people. That doesn't happen in a 5% Fed environment where business loans are 8, 9%. But that does occur in a 3% environment.
You're very
and
on this.
SoFi could be getting a very good piece of that. And if they were doing payroll, if they were doing a lot of other things, they would be able to service and capture probably a good majority of small and medium-sized businesses because they could act as a business development corporation without actually being a BDC.
Like for them to develop that, and I'm not saying that you're wrong in any way, but it's not like it's for them to publish SMB accounts would be free for them, right? You might be taking away from some other projects that maybe they're working on right now. And I think what Noto has said is that the consumer market is massive, right? There's so much TAM there. The growth might be similar whether they're focusing on one industry or going after both. Because that means you have to market differently. That means you have to do all these things potentially they don't want to have to worry about right now.
Consumer market is huge, but to get where the other banks are and to achieve the goal, they're not getting there without business solutions.
Yeah.
When you have the consumer side locked down and then you have the business side locked down, then you get the tech segment going and you start powering the competition, there's a much clearer path to becoming a top 10 financial institution. Show me a top 10, a top 20, or a top 30 that doesn't have a business segment.
Correct me if wrong, but I think it's more of a when, not if. That we know that they're going to go there at some point. They pretty much have to. But right now, there's a little bit more risk with those small and mid-sized businesses. They're just now entering GAAP profitability. There's a lot that they're focused on. And so I think that they may hold off for a year or two. If we get into a cycle where things are more stable for those that are entrepreneurs that are starting businesses, that might be a good time to rotate into that sector. But right now, it makes sense for me anyway that they just focus and try to maintain excellence across every platform that they have except for Invest because it's trash.
At least this is my interpretation from what I've heard is that they actually cannot compete with Robinhood, that they aren't even going to try anymore. Level 1 options are getting pushed. All these things are getting pushed. And what they're really going to do is try to go after more of a product line like Acorns, more automated, simplistic, beginner level investing products, more for the average person to get into, which are still very highly monetizable, if not maybe even more. Maybe not good for the people who are listening right now, who are maybe much more active investors.
Maybe that direction would pay off. Think about it. They've built out, or they are building out, financial advisory services. They have a banking charter. Maybe it makes more sense for them to have a full asset management arm and wealth management arm and become a custodian for businesses on a 401k level, 403 level, generate a very small fee for asset management, but look at the entire scale the way these other large institutions do, rather than trying to compete with a Robinhood or a Fidelity or a Schwab with options.
We might know all the components to their roadmap because we've seen the blueprint played out in other fintechs and other, traditional legacy players in terms of the branches that they have. What we don't know is we don't know the order that roadmap is going to go. The interesting piece right now is that profitability is such a big driver. So many eyes are on profitability. We've had a full year where they've guided for this thing. Like, I'm very curious to hear what the guidance is for 24, because that guidance for 24 is really going to dictate what they're expecting in terms of revenue growth, and also hopefully at the segment level as well. I want to see what that lending segment revenue growth is going to be, keeping in mind Chris Lapointe's comments around the remaining segments making up more of a contribution. Overarchingly, I want to see what the new spotlight is going to be shown on. If 2023 was the year that SoFi reaches profitability, what is 2024? Whether that be an asset management arm of the business, whether that be them doubling down on the retail side of the business, SMBs, whatever it might be, I'm really curious to get management's comments on what that focus area for 24 is going to be, so that then we can sort of laser focus our efforts to drill down into that and to make some forecasts based on that.
Think about it like this. Your Fidelity, you have your low cost index fund that you are charging expense ratio of 0.02%, 0.03% to compete with BlackRock and Vanguard. And then you're the actual custodian of the plans, and you're generating an asset management fee on all of the accounts that are in your sphere. SoFi already has proprietary ETFs. It would be very easy for them to create proprietary mutual funds. The next step from that would be custodian on the plans for retirement funds. If they start with small and medium-sized businesses for doing checking and savings, they can work their way into it. And if they put them in proprietary index funds at a 1-for-1 ratio on the expense ratio on the fund side of 0.02 or 0.03%, they get that on the actual fund for the assets under management there, but then they also get the custodial account asset management fee also. So everybody gets dinged twice, just like they do from Vanguard or any of the other institutions. And that could gain a ton of speed over a several year lookout.
So this is supposedly on the roadmap already, at least from the rumors that I heard, that mutual funds will be coming out very shortly. My question is, to the people who are buying them, I never understand why people take mutuals.
Companies sponsored retirement plans in the US, we don't have an option. I can only speak
for
about
group plans and stuff.
I can only speak about two specific companies that I've worked for. There is a finance committee internally that works with the plan sponsor that's holding everything, whether it's a Vanguard.
Yeah.
And then they pick a group of funds people can choose from. Most companies do not open it up where you have 100% free reign the way that you would if you were self-employed and you put your retirement in a SEP. From company sponsored, you may have a block of 20 funds that you can invest in. And I've never seen an ETF in it. It's all mutual funds from what I've seen.
Even for SoFi at Work, which is their employee benefits program, mainly for student loan pay down, they do have retirement funds and everything like this, that if SoFi can offer their own mutual funds that potentially they even manage themselves, that could be part of the list of funds that are forced through SoFi at Work's retirement benefits program.
Sure.
Aside from that, I don't understand why a single person with an app on their own individual account would choose mutuals over indexes.
It's really like a catch-22, right? Because the people who know and who can do it, like they get out of mutuals. So you either don't know to get out of them or you can't get out of them because you're locked into like a group plan or something like that. My mom with her work account was locked into a group plan. If she wanted the matching, she couldn't get out, and they did work with mutuals. I also dated a girl who her RBC advisor at the bank put her on mutual funds with like RBC's funds. And she was just like, I don't know the difference. And so it fundamentally comes down to one of two things. You either can't get out of them or you don't know that there is a better alternative out there.
None of the things that you guys are talking about has anything to do with SoFi specific platform, which is what we're talking about, with them offering mutual funds and user-based individual funds. They would have the ability to choose whatever they like. They would have the ability to switch out of them, and they would have the ability to buy fractionally.
Tannor, all I'm saying is that an asset management firm would just bring in more revenue, and it would be just another reason for establishments to go with SoFi. They already have advisors, they already have planning. It is just a logical step in the progression. And you look at all these other big banks, they all have it in one way or another. And if Noto's goal is to get there, it's got to be on the roadmap somewhere.
Is it a rumor that SoFi is not providing level one options now, or is this definitive? It's a rumor right now that SoFi has pushed level one options to 2025, the beginning of 2025. If one pillar of this rumor is true, does that make everything true? So it's right now, it's a rumor. The crypto deplatforming, to me, hearing it from Bender, he's been spot on a lot of places. He had verified through his own sources saying that the discontinuing of crypto down to the exact same wording. It will be an offering to go to blockchain.com, was confirmed by Bender 9000. In that same respect, I had also heard that level one options were getting pushed to 2025, that automated investing will be the focus for 2024, and that mutual funds and another product will be coming out within the next weeks.
It's interesting that these are areas where Robinhood excels, and they're just like, you know what? We're not going that way. There's a lot of moving parts to this, but one thing that would make a lot of sense to me if they could get around the legalities, and Robinhood and SoFi merging. It's like what Robinhood is terrible at, SoFi is strong or has a presence. They have the bank charter. Robinhood actually has an amazing investing platform and amazing crypto platform as well, and they have the options already. And it's like, man, it just makes a lot of sense. Don't know about OCC, the legalities of that, as far as like what to do with the Vlad and those sort of pieces. That would be things to work out. But to me, it makes a lot of sense. And it's one of those things that would help SoFi grow as a institution, a financial institution, much more rapidly. Like it just, I don't know.
I think you're spot on. I think that's really good. I just think that it's the Vlad situation for me. It's like, what the heck do you do with that guy?
It's just because the stink of the GameStop saga. He's not a bad CEO at all. He has some good vision. He's not nearly as competent as Anthony Noto, but he's an okay manager of funds. So I don't think he's nearly as bad as people say, but he loves stock-based compensation, and I don't want to pay what he's getting right now should a merger actually happen. So like how that would actually happen, how long it might take, the legalities of everything. But I think that these two companies together just make a whole lot of sense. I don't think that SoFi is intentionally moving away from crypto and options trading, but it makes a lot of sense that if you're behind the scenes in talks with Robinhood trying to work out a potential merger, to kind of back away from that. And also, Robinhood uses, well, we don't know about Technesis, but Galileo. So
we do know they use Galileo.
I don't know that I would be in favor of SoFi and Robinhood joining forces. The financials to me are not that appealing. Put the balance sheet aside. We know they have a ton of cash. I'll show that in a second. The cash per share is almost the entire share price. Putting that aside, in March of 21, they were losing a ton of money. Now, even if you go into write-downs and everything else, going public, okay, they were profitable on an operating level before write-downs in March and June of 21. You go into September, when broker commissions started going down, net interest income was still not much. They were losing a ton of money on operating income. And without as much write-downs, they were still losing a ton of money on net income. It didn't matter if net interest income was low and brokerage commission was high, or net interest income was high and brokerage commission was lower. This company does not generate a profit. They're getting closer. They generated 22 million profit in June, lost 75 million last quarter. Is this a company that can actually get profitable when things switch again? I don't know.
Easily. The reason why I lost money is because of a lawsuit. So that'll hit next quarter as well, but they'll hit profitability anyway. Cash swaps are, of course, incredibly profitable. They're expanding to UK. And then just think of it, I don't know what like the amount, the price tag, how that all work as far as a potential merger, but it would be a merger, it wouldn't be a buyout. But you would bring in all those assets that Robinhood has. You would not be capital constrained in that scenario. All of a sudden, you'd have a massive amount of liquidity there to be able to use.
Their balance sheet is awesome. Long-term debt, nothing. Beautiful. Huge equity, which is almost the entire market cap. You have a book value of 762, and then cash on hand is almost 5 billion.
The other thing you have to think about is because it's so synergistic with regards to like what Roy was saying earlier, like Robinhood fills all the gaps that SoFi has, and SoFi fills all the gaps that Robinhood might have in terms of the other verticals. The aggregate multiple on a merged entity would be much larger than the sum of the parts. So you got to think about that as well, because right now SoFi is being seen, as just the bank. Right now, SoFi's main criticism is their Invest app. All of these objections, a lot of them, the vast majority of them would definitely go away were they to have a clean merger. I would love to not have Vlad. Realistically, that's not going to be the case. He's still going to be there. And the compensation that he has as a CEO is just ridiculous. So there are things to clean up. But I do think that if that merger were to happen, that's when you get into a different way of thinking with regards to the multiple altogether.
Maybe I just have a bias toward it because I don't understand why anybody would use Robinhood compared to any of the other platforms out there. I've said that for years. I don't get it. It makes zero sense to me.
No offense to you, Stephen, but your opinion doesn't.
No, of course, the
It's the
market
opinion of the
matters, and they have a
23.3
lot of
million
companies.
people.
I get
It really targets who SoFi primarily targets as well, millennials and Generation Z. It just very synergistic, and those Robinhood users. I mean, it's an opportunity for SoFi to cross sell products to that user base and vice versa. So it's where I think the sum of the parts, the whole is greater than sum of the parts.
You can also think about like the opportunity cost of having these two separate technology teams building essentially the same roadmap and competing with each other, where
Yeah.
when you merge, you can literally just aggregate onto Robinhood's team for them to build the entire Invest platform and then repurpose all of that headcount, all of that, human resources onto building something else. And so they can even build faster from a product development roadmap perspective from that merger, because now all of a sudden you have other teams covering your bases.
And the X1 credit card also fits that really well, because I that's one product I don't think SoFi does particularly well.
My biggest concern with Robinhood was I believe their members have gone down. I just don't like the income statement. I love the balance sheet, don't like the income statement.
Yeah, well, you have to remember this is their winter. Things could not be worse as far as macro. And as the market continues to improve, as crypto improves, I don't foresee that's going to continue with Robinhood, and especially as they expand overseas for the UK. I talked to many people that are traders and investors in Europe, and they're extremely interested and excited because there's just 2 or 3 brokers over there. They're like, no, we want Robinhood. Yep.
Why would anybody use Robinhood over Interactive Brokers?
User interface is one reason for newer users. It's a lot easier, but beyond that, fees.
Problem with Interactive Brokers, in my opinion, is they kind of have that like painter's dilemma thing where it's like, hey, we've got these 80 different colors. Which one do you want your kitchen to be painted? And it's like some people want 3 choices. And that difference is huge. Just because you offer more options doesn't actually make it a better product for the end user.
I think the interface is better with Robinhood, and you have a limited selection. They actually kind of carefully curate, for the most part, a lot of the garbage coins. I mean, there's still Doge, and I think Shiba Inu maybe. And so ease of use. It's very simple, and that's what you need. That's where you're starting. Robinhood also has a very good education platform as far as teaching you about options, teaching you about crypto, teaching you about equities.
That type of merger would certainly increase SoFi considerably.
And the multiple, I think. I think Tevis is right there.
Yeah, Tevis is probably right. The market would probably look very favorable around it, especially if Noto was at the helm.
That's the main thing. Vlad is the cancer around this stuff.
Mm-hmm.
So Anthony Noto bought more SoFi this week. We suspected this. Last week we said, he sometimes buys in batches. Last week he bought 44,000 shares. This week he bought 22,500 shares. The interesting part I found just scrolling through Fintel, he's bought around 500,000 shares this year. on the open market, most of them in the $4 and $5 range. In 2022, he bought over 2 million shares. In 2021, he bought shares as high as $14 per share, and he holds over 7.2 million shares. And, I think the main takeaway for me was just, obviously, this is something that we reiterate every time he buys. He buys when the stock is in distress. He's bought when the stock has been in the teens. But what other CEO really, have you seen doing this? A lot of them sell stock. It's their form of compensation. Nobody blames them for selling stock. They have a lot of reasons for selling stock. But the fact that Anthony Noto keeps buying shares, I see it on X every single time that he buys shares. In the comment section, there's always someone or a handful of people that say something towards the lines of, oh, like, I don't know anything about SoFi. I've actually never looked into the stock, but this seems promising that this guy keeps buying shares every single time. So I just think that it's amazing. It's bullish, even more bullish when you consider the market that we're in and the fact that every CEO left and right seems to be selling their stock, and heading into arguably a recession, this CEO is just buying hand over fist.
Yeah, and Chris Lapointe is also purchasing a little bit as well. So I'm very excited that Anthony Noto continues to buy. He definitely has found a range where he likes to buy anything under 7. We'll see you guys on the next one. Bye for now.